Let's talk about inflation. Now, I know you see it in the headlines all the time, but we're not going to talk about it like that. We're going to get into what it actually means for your money, your wealth, and, the investments you're counting on for the future. Because inflation, it isn't just some abstract number on the news. It's a real personal force that can quietly change your entire financial life, for better or for worse.
All right, so here's our game plan for the day. I want you to think about this whole topic like an onion. First, we're going to peel back that outer layer, what inflation is and why it's such a huge problem for anyone with, say, a savings account. Then we'll keep peeling, looking at how it smacks around different assets. We'll uncover a really key secret from Warren Buffett, and then finally, we'll get right to the core, how you can actually build a portfolio that can handle whatever the economy throws at it.
So let's start with that first layer, inflation, the silent thief. This is really the core problem we're trying to solve here. It's a totally natural instinct, when the markets get crazy or the news is scary, to think, hey, the safest place for my money is just cash. I'll pull it out, stick it in the bank. But, as you're about to see, in a world with inflation, just holding cash is a guaranteed way to lose.
I want you to really think about this for a second, personally. Is your bank account leaking? I know it sounds a little dramatic, but when you really factor in inflation, the answer for most of us is a huge yes. Your bank statement might say you have $10,000, right? And that number doesn't change. But what that 10 grand can actually buy, well, that's shrinking every single day. It's like this slow, invisible leak.
A really powerful way to think about inflation is as a hidden tax. You don't get a bill for it. You're not writing a check to anyone. But it works just like a tax. It takes your wealth away without you even noticing. If your $100 bill today only buys what $97 could buy last year, well, you've just been taxed 3% on your cash without even knowing it. It's sneaky because it literally punishes you for trying to be responsible and save.
And this, right here, just shows you how big the problem is. The numbers are just stark. Most savings accounts right now are paying out, less than 1%? Meanwhile, let's just use a historical average for inflation, say around 3.6%. So your bank's giving you this tiny little crumb, while the actual value of your money is eroding at a way, way faster rate. You're losing ground every single year. You have to make more than 3.6% just to break even, and your safe savings account isn't even playing in the same league.
Okay, so if sitting on cash is a losing game, what's the first line of defense? Well, investing, of course. So let's peel back that next layer of our onion and compare the two big ones, bonds and stocks, and see how they stack up against this silent thief. Most people's portfolios are built on these two, so understanding how they act is absolutely critical.
First up, let's talk about a bond. A bond is basically just a loan. You lend a company, or maybe the government, $1,000, and they promise to pay you back with interest. That interest, it's called the coupon. So in this case, the coupon is 5%. Looks pretty good, right? You get your $1,000 back, plus an extra $50. But here's the catch. If inflation that same year was also 5%, then the price of everything, it also went up by 5%. So that $1,050 you're holding, it can only buy the exact same amount of stuff that your original $1,000 could buy a year ago. Your gain in dollars was 50, sure, but your real gain, your actual purchasing power, was 0. You just spent a year running in place.
Now, let's look at a stock. A stock isn't a loan. It's ownership. You own a tiny little piece of a real, actual business. So when that same 5% inflation hits, the company's costs go up. But a good business has what's called pricing power. It can just raise the prices of its own products to make up for its own rising costs. And if it does that well, its income should also rise by about 5%. And because your shares are a piece of that income, their value, it rises right along with it. Your investment has this built-in ability to adapt to keep pace with inflation in a way that a fixed-rate bond just can't.
Okay, so stocks usually beat bonds when inflation is high. We get that. But here's where things get really interesting. Not all stocks are created equal. And this brings us to a much deeper layer of the onion, a secret from Warren Buffett himself that really separates the good businesses from the truly great ones, especially when inflation is running hot.
This is one of Buffett's most famous lines, and it's really the key to everything. He's basically saying you can't just look at a stock price and think, oh, that's cheap. You have to look at the business underneath it. A company that looks cheap on paper might be a terrible value because it needs a ton of money, a ton of capital, just to stay in business. And when inflation hits, that becomes a massive, massive problem. Let's see why.
So to get this, we're going to use an example based on one of Buffett's all-time favorite businesses, See's Candy, and we'll compare it to this made-up, boring Square company.
Now, look, they both make the exact same amount of money, $2 million in net income. But look at the difference in net tangible assets. That's the physical stuff they need, like factories and trucks. C's only needs $8 million worth of that stuff to make its profit. But Boring Square Co., it needs $18 million. It's way more capital intensive.
Okay, now let's throw a huge wrench in the works. Let's say a massive economic shock hits. 100% inflation. Wild, I know. But this means the dollar is now worth half of what it was. So to keep their real profitability, both companies now need to make $4 million in income, not $2 million. So the big question is, what's it going to cost them to do that?
Well, because of that 100% inflation, the cost of all that physical stuff, the factories, the equipment, it's also doubled. So for See's Candy to double its income, it has to go out and invest another $8 million to buy the new, more expensive stuff it needs. But look at Boring Square Company. Because it needs so much more physical stuff, it has to invest an incredible $18 million more just to get the same $2 million increase in income. It is running so much harder just to stay in the same place.
And this is the magic number. This is the payoff. After all is said and done, Boring Square Company has just burned through a mountain of cash just to tread water. It's created zero extra value. But See's Candy, it's created an additional $6 million in market value. Why? Because most of its value isn't in its factories. It's in its brand, its reputation, the feeling you get when you see that box. Buffett calls this economic goodwill, and that goodwill is inflation-proof. A brand doesn't need to be replaced at higher prices. That's the secret. Find businesses that don't need a ton of capital to thrive.
All right, now for one of the absolute weirdest effects of inflation. We know it's terrible for savers, for people holding cash. But what if I told you that for people with certain kinds of debt, inflation can actually be a huge win? I know. It's a strange, counterintuitive idea that kind of flips our whole way of thinking about debt on its head. This is such a great way to wrap your head around this. Just imagine a crazy world with hyperinflation, where a single banana eventually costs, I don't know, hundreds of thousands of dollars. Well, if you had locked in a mortgage years earlier, you could theoretically sell one banana and use that now worthless currency to pay off your entire house. It's an extreme example, obviously, but it perfectly shows the principle. Inflation eats away at the real value of debt. So let's walk through how this actually works. Say you take out a $300,000 mortgage, and it's a fixed-rate mortgage. That's the key here. Your payment is locked in. It will never ever change for 30 years. Now, over that time, say inflation goes up a lot. Your wages probably go up, prices of everything go up, but that debt payment, it stays exactly the same. The $300,000 you owe in year 29 is a much, much smaller burden than it was in year 1. You're literally paying back an old loan with the cheaper, less valuable dollars of the future. It's pretty incredible.
So the crucial takeaway here is that you don't just have to sit there and take whatever the economy gives you. You can actually be proactive. You can protect your wealth. And that brings us to our next layer, hedging. This is where we start moving from just being an investor to being a more sophisticated risk manager, using the same kinds of tools the pros use.
Now, hedging is not the same thing as diversification. Diversification is just, owning a bunch of different stuff and hoping for the best. Hedging is way more precise. It's really like buying insurance for your portfolio. You spend a little bit of money on a specific asset that is designed to go in the exact opposite direction of your main investments. The goal isn't even necessarily to make a ton of money on the hedge. The goal is for it to act like a shock absorber, to protect you if your main investments take a nosedive.
And this quote just brilliantly captures the whole mindset behind hedging. Look, you can't stop a market crash. You can't halt inflation. The ship might hit an iceberg, but what you can control is whether you have a plan, a lifeboat, before it happens. A hedge is your financial lifeboat. You hope you never need it, but you're going to be incredibly glad it's there if you do.
So here's a real-world example of what that looks like. Let's say the stock market has a terrible month and drops 15%. If you only own stocks, well, you're down 15%. But what if you had put a small piece of your portfolio, say just 2 or 3%, into a hedge like VXX? It basically tracks market fear. So when the market panics and falls, this thing spikes. So while your stocks are down big, your VXX position could be up 100%, cushioning that blow to your overall portfolio. Now, this insurance isn't free. These things often lose money in calm markets, but it can be an absolute lifesaver during a storm.
And that brings us right to the core of it all. We've peeled back all the layers. We get the threat of inflation, we know how different assets react, we know the secrets to finding great businesses, and we have tools for risk management. Now we just have to put it all together. And the goal isn't to predict the future. That's a fool's game. The goal is just to be prepared for any economic season. This is really what it all comes down to. Building an all-weather portfolio is really about building a resilient mindset. It means you make decisions based on a solid strategy, not based on the fear or greed you're seeing on TV. It means you focus on real assets that actually produce cash. It means you truly get Buffett's lesson that price and value are two totally different things. And maybe most importantly, it means you accept you can't control the market, but you can 100% control your own preparation and your own strategy.
So I'm going to leave you with this final thought. Take a really hard, honest look at your own investments. Is your portfolio just a collection of things you're hoping will go up, or is it a carefully constructed machine, built with a deep understanding of inflation and value and risk that's truly built to handle reality, no matter what that reality turns out to be? That's the question we all need to answer for ourselves. Thanks for tuning in.